Most investors only notice SCHD when it's topping the charts. Right now, it's around a 4% yield again, and people are buzzing. But here's the thing, that level has only shown up in short windows, and every time it did, opportunities slipped by fast. We'll break down the numbers and see what they actually mean. And just so it's clear, this is factual data, not investment advice. Past results never guarantee what's next. Now, here's the hot take. Ignoring SCHD's 4% yield might be one of the biggest mistakes dividend investors make. Do you think that's true? Let's start simple. SCHD is paying close to a 4% yield right now. That number may not sound dramatic, but for this fund, it's a big deal. Why? Because SCHD rarely offers a yield that high. Most of the time, it sits closer to 3%. So when you suddenly see it cross 4%, it means one of two things. Either the price of the fund has fallen, or the dividend payments have grown faster than the share price. In 2025, both of those came together. The fund dropped more than 10% over 6 months. At the same time, the dividend kept climbing. That mix is what created today's higher yield. And here's the key point. Historically, these moments have been rare. They don't stay around for long. That's why people keep recommending SCHD right now. It looks like a chance that doesn't appear every often. Chapter 1. Yield History, Inception, Averages, and Extreme Days. Now let's zoom out. SCHD launched back in October 2011. Since then, we have thousands of trading days of data. Across that whole period, the average dividend yield was about 2.9%. That's the baseline. For most of its life, SCHD has hovered between 2.5% and 3.5%. Only a handful of times has it ever gone above 4%. Let's put numbers on it. Out of over 3,300 trading days, only around a dozen closed with yields at or above 4%. That's less than 1/2 of 1% of the time. The most famous example came in March 2020. During the COVID crash, SCHD's yield shot up to 4.36%. That was the highest in its history. Fast forward to 2025, once again, SCHD touched around 4.27% at its peak. And for a short stretch, it held around 4.05%. That puts today's environment in very rare company. We're talking about yield levels that investors usually only see once a decade, if that. So when you hear 4%, it's not just another number, it's a historical outlier. And that makes people wonder if it signals another strong entry point. Chapter 2. Performance Evidence, Best Buy Days, Total Return Patterns. History gives us clues. Let's check what happened after past high-yield moments. The single best day to buy SCHD so far was March 23, 2020. That was the exact bottom of the COVID crash. From that day forward, the fund delivered about a 15.9% annual return. That's huge for a dividend ETF. And it's not just one lucky date. The 5 best entry points all came during that same March window, when yields were above 4%. Investors who stepped in during those rare days saw outsized long-term gains. And here's another pattern. On average, when SCHD's yield was above 3.75%, later returns were stronger than the long-term average. That suggests yield levels can be a rough timing signal. Not a guarantee, but a useful clue. Of course, we can't simply assume the future repeats the past. But the data does say this. Historically, when SCHD's yield got this high, patient buyers were rewarded more often than not. Chapter 3. Thresholds and Correlations, Yield Bands that Historically Outperformed. Now, let's break it down by yield bands. Researchers went back and sorted every trading day by yield level. Then they asked a simple question. How did returns look if you bought only days above certain thresholds? The answers are interesting. When the yield was 3% or higher, results looked solid. But when it crossed 3.75%, the numbers improved a lot. Average compound annual growth rate jumped to around 10.6%. And when the yield hit 4% or higher, the average return was even stronger, around 14.1%. That's far above the long-term average. So historically, higher yields were linked to better forward returns. But here's the catch. These signals only appear during market stress. They don't last forever. Once prices recover, the yield drops back down. So the key is simple. The bigger the yield, the rarer the moment, and the better the historical payoff. Chapter 4. Fund Mechanics and the 2025 Rebalance. Composition matters. Of course, yield alone doesn't tell the full story. We also have to look inside the fund. SCHD isn't a static basket. Every March, it goes through a reconstitution. That means stocks get added or removed based on strict rules. In 2025, this process made some big shifts. Around 20 new companies entered the portfolio. The fund tilted a bit more toward energy and financial stocks. At the same time, its exposure to technology stayed low, only about 7 to 8%. That's unusual compared to the broader market, which is heavily tech-driven. These choices matter. Energy and banks often carry higher dividend yields. Tech, on the other hand, tends to reinvest earnings instead of paying them out. So the 2025 rebalance helped keep SCHD's yield elevated. It also gave the fund more exposure to sectors that swing with the economy. That balance shapes how it behaves. Chapter 5. Risk Profile, Volatility, Downside, and Dividend Growth Metrics. Let's be clear, SCHD isn't risk-free, but the numbers show it behaves differently from the overall market. One measure is volatility. SCHD's volatility score comes in around 0.62%. That means it tends to swing less than the S&P 500. But even with lower volatility, it can still fall. In early 2025, the fund was down more than 10% from its highs. Year to date, it slipped about 6%. So drawdowns are real. Yet, here's where SCHD stands out. The dividend has been growing at a steady pace. From 2013 to 2024, the annual dividend rate increased by roughly 11.6% each year on average. That's a strong growth rate for a fund built on established companies. It means income hasn't just been stable, it has expanded quickly. So even when the share price pulls back, investors still see their cash flow rising. That's a key reason why SCHD stays on top of dividend ETF lists. Less volatility, more dividend growth. That mix keeps it attractive. Chapter 6. Flows and Market Signals, Institutional Buyers and Timing Context. Now, let's look at who's been buying. During recent sell-offs, institutional investors increased their positions in SCHD. That's worth noting. When large funds add exposure during market weakness, it usually signals confidence in long-term stability. But it's not a guarantee. It simply shows where professional money managers are positioning. At the same time, headlines around trade policy and tariffs pressured growth sectors. That rotation pushed yields higher in dividend funds like SCHD. So the elevated yield isn't only about company payouts, it's also about market mood. Institutions leaning in, retail investors hesitating, and macro uncertainty creating swings. Together, these flows give us context. SCHD's 4% yield is partly fundamentals and partly market sentiment under stress. Chapter 7. Practical Playbook, What a Pragmatic Investor Can Do. So what can you actually do with all this information? Let's keep it simple, almost like a checklist. First, define your goal. Are you investing for steady income or for long-term growth? That choice matters. Second, watch the yield bands. History shows yields above 3.75% or 4% have been rare and often followed by stronger returns. You can use that as a signal to consider adding, but size your position to your own risk. Third, dollar cost averaging helps. Buying gradually reduces the pressure of picking the perfect day. Fourth, pay attention to the March reconstitution. That's when SCHD changes its holdings. Adding or trimming around those dates can make sense. Fifth, don't just chase yield. Look at the fundamentals of top holdings. Are their payout ratios healthy? Are cash flows strong? Sixth, think in percentages, not dollars. For many investors, SCHD might be 10 to 30% of a dividend-focused sleeve, depending on risk. So the playbook is not about guessing. It's about having a plan, using history, and sticking with discipline. Before we wrap up, here's the important part. Nothing here is financial advice. This video only shows historical data and fund facts. Past performance never guarantees future results. Dividend yields move with both prices and payouts, and both can change quickly. Always do your own research, and if you need personal guidance, talk to a licensed advisor. YouTube requires me to say this clearly. The point is simple. Learn from the data, but make decisions that fit your own situation. So here's the bottom line. SCHD's yield near 4% is rare. History shows those moments often lined up with stronger long-term returns, but they don't last long. That's why the fund keeps topping dividend ETF lists. Drop a comment with your thoughts. Do you see SCHD as better than the S&P 500 for income? Thanks for watching.